Imagine peeking over the shoulders of billionaires like Warren Buffett, Oprah Winfrey, or Mark Cuban, and taking notes on exactly how they handle their money. Far from a hypothetical spy scenario, this guide lets you do just that, minus the legal ramifications. While these super-rich individuals each have unique stories, many of them use surprisingly similar strategies to build, protect, and multiply their fortunes over time. In what follows, we'll dive into 10 key money secrets billionaires commonly practice. You may think these strategies are locked away in an exclusive playbook, but in reality, you can adopt them no matter your income level, often with just a shift in mindset and some basic financial discipline. To make things more concrete, you'll also see real-life examples and events that illustrate how these principles work in the real world. Let's open the vault. When Elon Musk first co-founded Tesla, he reportedly used personal loans, partly backed by his shares in PayPal, which he'd sold, to help fund the new venture. Musk wasn't interested in piling up consumer debt for fancy cars or yachts. He was laser-focused on growing a company he believed would change the automotive industry. Good debt versus bad debt. Billionaires draw a clear line between good debt, loans that finance appreciable assets or business expansion, and bad debt, credit cards or loans for depreciating items. Leveraging low interest rates. By borrowing at a relatively low rate, they invest in projects or stocks that can potentially earn a higher return. Strict cash flow monitoring. Before signing any loan agreement, they ensure the underlying venture can generate enough revenue to service the debt comfortably. Instead of using credit cards for lavish expenses, consider a small business loan or real estate mortgage that can pay you back over time. The key is a rational plan, not a blind leap of faith. Bill Gates became the world's richest person, not by securing an astronomical salary from Microsoft, but by owning a huge chunk of the company's stock. Over decades, the company's growth multiplied the value of his ownership stake, far exceeding anything a salary alone could have achieved. Equity stakes. From Jeff Bezos, Amazon, to Mark Zuckerberg, Meta, tech billionaires hold massive equity positions in the companies they helped build. Compound growth. As a company's value rises, your shares become worth exponentially more. You're effectively earning returns on top of returns. Passive income. Dividends, buyouts, or secondary share sales allow owners to gain liquidity without giving up complete control. If you work for a startup or small company, negotiate for stock options in addition to, or instead of, higher pay. If you're an entrepreneur, keep as large a stake as possible. Owning assets that appreciate can outshine a bigger paycheck in the long run. 2021, a series of leaked tax documents hinted that some U.S. billionaires legally paid little to no income tax in certain years. While the headlines sparked controversy, it highlighted how the ultra-wealthy use existing tax laws, like capital gains treatment and charitable contributions, to minimize their taxable income. Corporate and trust structures. Holding assets in LLCs, corporations, or trusts can offer tax advantages and protect personal wealth from lawsuits. Capital gains versus ordinary income. Billionaires often earn most of their money through investments taxed at capital gains rates, rather than salaries, taxed as ordinary income. Charitable foundations. Donating appreciated assets to charity can provide big write-offs without requiring the donor to pay capital gains on those assets. Research. Whether forming an LLC makes sense for your side hustle. Contribute to tax-advantaged retirement accounts, like a 401k or an IRA, to reduce taxable income. Even small moves can add up over time. Oprah Winfrey famously transitioned from being a talk show host to creating her own production company, Harpo Productions, launching a magazine, a radio channel, and multiple brand partnerships. She turned her media empire into a diversified set of revenue streams that shielded her from being beholden to any single paycheck. Diversification of risk. If one stream falters, like a product line underperforming, others can keep the cash flowing. Reinvestment. Early profits from one project often fund the creation or acquisition of another, creating a self-sustaining cycle. Scalability. By hiring teams and forming partnerships, billionaires can manage multiple ventures simultaneously. Consider launching a side hustle or renting out a spare room as an Airbnb. Small, consistent earnings beyond your day job can fortify your finances. Reinvest those profits into high-yield savings or a brokerage account to grow your nest egg. Real-life event. In the aftermath of the 2008 financial crisis, many real estate moguls who didn't track their cash flow ended up over-leveraged. Meanwhile, those who understood and carefully managed their liquidity, like real estate billionaire Sam Zell, used the downturn as an opportunity to snap up undervalued properties at bargain prices. Monthly tracking. Billionaires and their teams meticulously review income statements, expense reports, and balance sheets, ensuring they always know how much money is flowing in and out. Cash reserves. Maintaining a buffer or easy access to credit allows them to act quickly when good deals emerge, without panicking. Avoiding distressed sales. By not stretching themselves too thin, they can hold assets during market dips until they recover or surpass previous valuations. Keep a simple spreadsheet or use budget apps to track your income and expenses. Aim to maintain an emergency fund so you're not forced to sell investments or property at the worst possible time. Warren Buffett is legendary for buying stocks during market panics. In 2008, when financial giants were on the brink, Buffett negotiated deals with Goldman Sachs and other firms, investing billions at discounted prices with favorable terms. As markets rebounded, his positions skyrocketed in value. Contrarian mindset. While the average person sells in a panic, billionaires deploy extra cash or credit lines to buy undervalued assets. Long-term vision. They're confident in the economy's eventual rebound, so they can afford to wait for the recovery. Structuring safe deals. In Buffett's case, he often secures special preferred shares or convertible notes, minimizing risk and ensuring returns. Instead of liquidating your retirement account when stocks dip, consider buying more shares if you believe in their long-term fundamentals. Keep a small portion of savings ready to invest during market pullbacks, when quality companies often go on sale. Zuckerberg might be the face of Facebook, now Meta, but behind the scenes, top-tier executives, engineers, and data scientists handle day-to-day operations. Zuckerberg focuses on strategic direction, product vision, and corporate leadership, while delegating critical tasks to domain experts. Value of time. Billionaires understand that their mental energy is finite. Rather than micromanaging every detail, they outsource tasks outside their core expertise. Systems and processes. They implement standard operating procedures so their teams can function efficiently, even in the billionaire's absence. Scalability. By empowering skilled professionals, they can grow multiple businesses or product lines simultaneously. You may not have a staff of 1,000, but you can outsource repetitive chores or use virtual assistants. This frees you to focus on higher impact activities, like acquiring new clients or learning profitable skills. In 2020, a group of big-name billionaires and CEOs came together to invest in COVID-19 relief, bridging the gap between industries, tech, healthcare, finance, to accelerate vaccine research and distribution. While money was key, it was their collective network that mobilized resources and expertise with lightning speed. Strategic introductions. Billionaires often connect people within their circles, enabling joint ventures that benefit everyone involved. Information sharing. High-profile groups, from exclusive clubs to philanthropic boards, offer advanced insights on market trends and potential deals. Personal branding. Public figures like Richard Branson or Oprah Winfrey build trust through authenticity and leadership, making people want to work with them. Attend niche industry meetups, offer help to others when you can, and follow up with new contacts. Over time, your network becomes a reservoir of knowledge, referrals, and partnerships you can tap into. Sir Richard Branson, founder of the Virgin Group, has launched everything from airlines to record labels and space tourism ventures. Not all of his ventures soared. Virgin Cars and Virgin Brides flopped. But Branson treats each failure as tuition for future success, quickly pivoting or shutting down ventures that don't gain traction. In-depth research. Most billionaires analyze market feasibility and potential returns before committing. They're not blindly rolling the dice. Fail fast, forward. If a startup or product fails early tests, they don't waste years trying to revive it. They salvage what's useful and move on. Risk mitigation. Billionaires often limit personal liability using corporate structures and diversified portfolios, so one disaster doesn't wipe them out. You don't need billions to try something new, be it a side hustle or an investment strategy. Start small, gather data, and if it flops, adapt or move on. Each failure can pave the way for a more refined approach in your next venture. Jeff Bezos famously told early Amazon shareholders that the company's profitability would take years to fully materialize, urging them to think a decade ahead rather than chase quick quarterly profits. That long-term mindset allowed Amazon to invest in infrastructure, research, and customer loyalty programs, eventually transforming it into an e-commerce and cloud computing giant. Steady compounding. By reinvesting profits into research, development, and acquisitions, they harness the power of compounding. Over 10 to 20 years, these small annual gains can balloon into massive growth. Ignore the noise. Billionaires tend to focus on fundamental value rather than short-term market volatility or sensational headlines. Legacy building. Many structure their wealth to endure well beyond their lifetimes, establishing philanthropic foundations or multi-generational trusts. Think in terms of 5, 10, or 20-year plans, whether investing in index funds, real estate, or your career. Don't panic sell at the first sign of trouble. If the fundamentals are solid, patience can yield spectacular returns. These 10 billionaire money secrets are neither impossible to grasp nor restricted to the elite. They're grounded in financial principles, like leveraging strategic debt, embracing ownership, focusing on cash flow, and maintaining a long-term perspective that anyone can adopt with a bit of knowledge and a willingness to adapt. Real-life events from Elon Musk financing Tesla to Warren Buffett scooping up bargains during market crashes prove that these ideas aren't just theories. They're strategies that shape the fortunes of some of the wealthiest people in the world. But knowledge alone isn't enough. The true magic happens when you put these principles into practice, even if it's on a smaller scale. No matter where you stand financially, begin by adopting even 1 or 2 of these secrets. Refine your approach, learn from mistakes, and stay consistent. While you may not become the next Elon Musk or Oprah Winfrey overnight, you'll be on track to significantly elevate your financial standing, and that's a path worth taking.